Imagine you want to buy Bitcoin right now. You open your phone, tap a few buttons, and boom, you own crypto. But have you ever stopped to wonder, what actually happened in those few seconds? Who matched your order? Who held your money? Who made sure you got the right amount? Today, we are pulling back the curtain on one of the most important pieces of the entire crypto world, the exchange. By the end of this video, you will know exactly how a crypto exchange works, the difference between the two main types, and why choosing the wrong one could actually put your money at risk. So stick around, this one is going to change the way you see crypto forever. Welcome back to Chain Decoded, the channel where we break down the complicated world of crypto into simple, easy-to-understand pieces. I am really glad you are here. In our last video, we talked about crypto wallets, what they are, how they work, and why they matter. Today, we're going one step further into the ecosystem. If a wallet is where you store your crypto, an exchange is where you actually get it in the first place. So what exactly is a crypto exchange? Think of it like a stock market, but for digital currencies. In a traditional stock market, buyers and sellers come together to trade shares. A crypto exchange does the exact same thing, but instead of company stocks, people are trading cryptocurrencies like Bitcoin, Ethereum, or Solana. At its core, an exchange has one job: connect someone who wants to buy crypto with someone who wants to sell it. It matches those two people, or bots most of the time, and makes the trade happen. In exchange for doing this, the platform takes a small cut, called a trading fee. Simple, right? Now, here is where it gets really interesting, because not all exchanges are built the same way. There are two completely different types, and understanding the difference is one of the most important things you can learn in crypto. Type number 1, the Centralized Exchange, or CEX. These are the big names you have probably already heard of: Binance, Coinbase, Kraken. These are companies run by real people with offices, employees, and legal licenses. Here's how a CEX works step by step. First, you sign up and verify your identity. This is called KYC, or Know Your Customer. They need your name, email, sometimes a photo ID. This is required by governments to prevent money laundering. Second, you deposit money. You can send regular fiat currency, like dollars or rupees, directly from your bank account or card, or you can deposit crypto you already own. Now, that last point is really important. When you use a centralized exchange, you do not actually control your crypto. The exchange does. There's a famous saying in the crypto world: not your keys, not your coins. We covered this in our wallet video. This is why we've seen disasters like the FTX collapse in 2022. When that exchange went bankrupt, millions of users could not access their funds because the exchange held everything. So what are the advantages of a CEX? Speed, trades happen in seconds. Ease of use, the apps are clean, simple, beginner-friendly. Customer support, you can email someone if something goes wrong. And liquidity, there are so many buyers and sellers that you can always make a trade quickly. Third, you place a trade. You say, I want to buy $100 worth of Bitcoin. The exchange's internal system, called an order book, instantly finds someone willing to sell Bitcoin at that price. The trade happens in milliseconds. Fourth, and this is crucial, the exchange holds your crypto for you. It sits in their wallet, not yours. You just see a balance on your screen. The disadvantages? You trust a third party with your money. You go through identity verification. You are subject to government regulations. And if the exchange gets hacked, as has happened many times in crypto history, your funds could be at risk. Now let us talk about the second type, the Decentralized Exchange, or DEX. This is where things get really cool, and also a little more complex. But do not worry, we're going to break it all the way down. Examples of DEXs include Uniswap, PancakeSwap, and DYDX. These platforms have no company behind them, no CEO, no headquarters. They're just code, smart contracts running on a blockchain. Here's how a DEX works. Instead of an order book matching buyers and sellers, most DEXs use something called an automated market maker, or AMM. Instead of finding another human to trade with, you trade directly with a pool of funds called a liquidity pool. Here's a simple example. Imagine a big shared pot that contains both Bitcoin and Ethereum. When you want to swap your Ethereum for Bitcoin, you put your Ethereum into the pot and take out the equivalent amount of Bitcoin. A mathematical formula automatically calculates the price based on how much of each coin is in that pool. The people who put money into that pool are called liquidity providers. They earn a small percentage of every trade as a reward. It's a way for regular people to earn passive income in DeFi, or decentralized finance. And because everything happens through smart contracts on the blockchain, it's transparent, automatic, and no single person is in control. The biggest advantage of a DEX? You keep control of your crypto at all times. You connect your wallet like MetaMask and trade directly from it. The platform never holds your funds. No KYC, no identity verification. The disadvantages? It can be more complicated for beginners. The fees can sometimes be higher because of blockchain gas costs, and if you make a mistake, like sending to the wrong address, there's no customer support to help you. The blockchain does not care. The transaction is final. So to quickly recap, CEX is like a bank. They hold your money, make things easy, but you have to trust them. DEX is like trading directly peer-to-peer with code as the middleman. More control, more responsibility. Let us go a little deeper into one concept that you will see every time you open a trading platform, the order book. Even if you never plan to be an active trader, understanding this will make you feel like a pro. An order book is basically a live list of all the buy and sell orders waiting to be matched on an exchange. It has two sides. On one side, the bid side, these are buyers. They are saying, I want to buy Bitcoin and I am willing to pay up to this price. On the other side, the ask side, these are sellers. They are saying, I want to sell Bitcoin and I want at least this price. The exchange continuously tries to match bids with asks. The moment a buyer is willing to pay what a seller is asking, boom, the trade executes. The price at which the last trade happened is what we call the current market price. The difference between the highest bid and the lowest ask is called the spread. On big exchanges with lots of activity, this spread is tiny, sometimes just fractions of a cent. On smaller or less liquid exchanges, the spread can be much larger, which means you might get a worse price than you expected. There are also two main types of orders you can place. A market order, where you say, just buy it at whatever the current price is, fast, and a limit order, where you say, only buy it if the price reaches this specific number. Limit orders give you more control, but might not execute immediately if the market does not reach your target. Quick question. If a DEX has no company and no employees, how does it sustain itself? And how do CEXs make money? CEXs make money primarily through trading fees, usually somewhere between 0.1% and 0.5% per trade. They also earn from withdrawal fees, deposit fees, listing fees when a new crypto project wants to be listed on the exchange, and sometimes interest on funds held. DEXs collect trading fees automatically through their smart contracts, usually around 0.3% per trade. That fee goes directly to the liquidity providers who keep the pool funded. Now, the most important part of this entire video, staying safe on a crypto exchange. Number 1, always enable two-factor authentication, or 2FA. This means even if someone gets your password, they cannot log in without a second code from your phone. Use an authenticator app, not SMS, because SIM swapping attacks are real. Number 2, never keep large amounts of crypto on an exchange for long periods. Remember, not your keys, not your coins. Move your funds to your own wallet, especially a hardware wallet for long-term storage. Number 3, only use well-known regulated exchanges. Check if the exchange is registered in your country and has a strong track record. Look up their history, read reviews, check if they have ever been hacked. Number 4, be careful of phishing websites. Scammers create fake exchange websites that look exactly like the real one. Always double-check the URL, bookmark the real site, never click exchange links in emails or DMs. Number 5, understand the fees before you trade. Some platforms charge high fees that can eat into your profits, especially if you are making small trades. Always read the fee schedule.
So, with dozens of exchanges out there, how do you pick the right one for you? Here is a simple framework. If you are a complete beginner who just wants to buy some Bitcoin or Ethereum with your bank account, start with a centralized exchange like Coinbase or Binance. They are beginner-friendly and regulated. If you are interested in DeFi, want to trade newer altcoins, or want full control of your funds, explore a DEX like Uniswap. Just make sure you already have a wallet set up and you understand how gas fees work. And if you want both, many advanced users keep a small amount on a CEX for easy trading and move the bulk of their holdings to a cold wallet. Best of both worlds. The most important thing is this: do your research before you deposit a single dollar. Read about the exchange. Test it with a small amount first. Take your time. Okay, let us do a quick recap before we go. A crypto exchange is a marketplace that connects buyers and sellers of cryptocurrency. There are two main types: centralized exchanges, or CEXs, which are company-run platforms that hold your funds and are easy to use, and decentralized exchanges, or DEX, which are code-run platforms where you keep full control of your crypto. Exchanges use order books or automated market makers to match trades. They earn money through fees. And most importantly, your security is your responsibility. Use 2FA, do not leave large amounts on an exchange, and always double-check everything. If this video helped you understand crypto exchanges even a little bit better, smash that like button. It really does help the channel grow. And if you want to keep learning, subscribe to Decoded. We post every week, and every video is designed to help you understand crypto from the ground up. In the next video, we are diving into something a lot of people find confusing: blockchain transactions. How does your crypto actually move from one wallet to another? We are going to break it all down. See you then.